Hi professionals, welcome to Tax Guru YouTube channel. This is CA Rohan R. Pingale, practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. Welcome to our video series of What Law Says, Income Tax, Part 4. In this video series, in every part, we discuss case laws reported to ITAT and reported to High Court. Today is part 4. Let's dive into it. Let me allow to share my screen. What law says? Direct tax part 4. First case law for today is Jivang Gani Films versus JCIT ITA number 382 Mumbai of 2025, assessment year 2015-16, date of order is 6th March 2025, and relevant sections are sections 269 SS and section 271D. Let's understand facts and issue of the case. The assessee of a partnership firm active in film production, distribution, and related services engaged a vendor referred to as Messrs. R. For the financial year 2014-15, the assessee obtained a rupees 15 lakh loan from NBFC, that is non-banking financial companies. Instead of receiving the amount directly, the NBFC disbursed it straight to Messrs. R via banking channels. Separately, the assessee paid rupees 10 lakhs, that is, firm paid rupees 10 lakh to the same vendor from its own funds. The firm recorded the non-banking financial companies, that is NBFC loan of rupees 15 lakhs as a journal entry in its books acknowledging the liability. During penalty proceedings under Section 271D of the Income Tax Act, the assessing officer treated this liability entry as contravention of Section 269 SS, which prohibits accepting loans otherwise than by prescribed banking modes, and levied a penalty of rupees 15 lakhs. The tribunal's key question is, does a loan recognized via journal entry but disbursed through banking channels fall under the provision of Section 269 SS? A very important question under consideration was, does a loan recognized via journal entry but disbursed through banking channels, proper banking channels, fall under the prohibition of Section 269 SS? This was the issue under consideration. Let's see what tribunal observed and held. There was no dispute over the 15 lakh loan disbursed through proper banking channels and confirmed by both the NBFC and the vendor. The assessee had a genuine liability and recorded the loan via journal entry. The tribunal emphasized that Section 269 SS is designed to prevent cash-based loan. 269 SS is designed to prevent cash-based loan or deposit transactions. Its scope is limited to actual acceptance of money and doesn't extend to mere book entries that record liability. Section O is limited to actual acceptance of money and doesn't extend to mere book entries that record liability. And therefore, the tribunal held that the transaction was outside the purview of Section 269 SS, since no cash or other prohibited mode of acceptance occurred. It was a journal entry acknowledging an obligation. Consequently, the imposition of penalty under Section 271D was invalid and the appeal was allowed in favor of the assessee. Next case. Deepak Parmar versus ITA number 178, SRB 2024, assessment year 2017-18, date of order is 19th November 2024, and relevant section is section 69A of the Income Tax Act. Today onwards, from this part, at the end of the session, we also went through conclusions drawn from the cases discussed. So that part will help you to summarize our all these decisions. So we will take that at the end of the session. Okay, just for your information. So let's understand the facts and issue of the case. The assessee Deepak Parmar filed his return for assessment year 17-18, declaring income of rupees 2,78,400. During the year, he paid rupees 6,16,142 in cash towards credit card dues held with RBL, SBI, and Citibank. What he had done is during the year he paid rupees 6,16,000 in cash towards credit card dues held with RBL, SBI, and Citibank. The assessing officer issued show cause notice and statutory notices seeking explanation for the source of cash payments. The assessee failed to respond to any notices from the AO and CIT appeals. Assessee failed to respond. The AO added 6,16,142 as unexplained cash under section 69A and applied the penal tax under section 115 BBE. The CIT appeals confirmed the addition for lack of compliance and reasoning. Let's see what tribunal observed and held. The assessee made cash payments totaling rupees 6,16,142 for credit card bills. No explanation, documentation, or replies were filed at any stage. This is very important. No explanation, documentation, or replies were filed at any stage by the assessee. Section 69A triggers where an assessee is an owner of unexplained money and fails to satisfactorily explain its source. Very clear. What section 69 says is that an assessee, when assessee is an owner of unexplained money and fails to satisfactorily explain its source, then it will be triggered. Since the assessee didn't provide any explanation, section 69A was correctly invoked. The tribunal upheld both the assessing officer and CIT appeals orders. It dismissed the appeal, confirming the addition to rupees 6,16,142 as income under section 69A and the taxability under 115 BBE. This case was against the assessee. Next, JK Associate versus ITO, ITA number 1200, Ahmedabad, 2024, assessment year 2017-18, date of order is 5th December 2024, and relevant sections are section 68 and 69A again. Let's understand facts and issue of the case. Assessee, a partnership firm, had not filed its return for assessment year 2017-18. AO reopened the assessment under section 147 based on information that the firm purchased immovable property worth rupees 1 crore in financial year 16-17. In assessment under section 147, read with section 144B, AO added rupees 1 crore as unexplained investment under section 68 and 69A, treating contributions toward the property acquisition as unexplained capital. Whether capital contributions made by partners backed by their confirmations and genuineness can be treated as unexplained investment under section 68 and 69A in the hands of the firm was issue under consideration. Let's see what tribunal observed and held. The firm produced detailed confirmations and records showing the capital contributions of 12 partners. ITAT held that once the partner's identity, genuineness, creditworthiness, and the mode of fund introduction were satisfactorily proved, the onus on the assessee stood discharged. What ITAT held is that once the partner's identity, genuineness and creditworthiness and the mode of fund introduction were satisfactorily proved, the onus on the assessee stood discharged. If the AO doubted the source, any addition should be made in the hands of individual partners, not the firm. Very clear. AO, if doubted the source, any addition should be made in the hands of individual partner and not the firm. This principle aligns with established jurisprudence that Section 68 or 69A additions cannot be sustained once credibility of creditors or contributors is established. Means this is the important of this case is that the essence is that the credibility of the partners or contributors or creditors, if it is established, then 68 and 69 cannot be sustained. The tribunal allowed the appeal, setting aside the rupees 1 crore addition in the hands of the firm, means allowed the appeal with the assessee in the hands of, means in the favor of the assessee. Specifically, it ruled that the contribution by partners duly supported by confirmations and proof cannot be treated as unexplained investment under Section 68 or 69A when proper documentation exists. Next, Bishwanat Prasad vs. CIT Appeals ITA number 163 to 166 Patna 2023. Relevant assessment year is assessment year 2017-18 to 2020-21. Date of order is 29th August 2024 and relevant sections are section 270A and 270AA. Let's understand facts and issue of the case. The cases pertain to 4 assessment years following a search action at the assessee's premises. For AY 2017-18, the assessee filed a return under section 139 subsection 1 declaring an income of rupees 8,35,425. After the search notice under section 153A, he filed a revised return declaring rupees 13,97,270. The assessing officer completed the assessment under section 153A based on the revised return and imposed penalty under section 270A, citing under reporting of income. The assessee made a belated application under section 270AA seeking immunity from the penalty, which the AO rejected without providing any hearing. Assessee made an application and that is also belated under section 270AA seeking immunity from the penalty. The tribunal noted that, means what tribunal observed and held is that the tribunal noted the once the revised and assessed incomes are the same. Once the revised and assessed incomes are the same, no underreporting arises under section 270A subsection 2. Very important. Whenever revised, return and assessed income are the same, revised and assessed income are the same, no underreporting arises under section 270A subsection 2. It also emphasizes the procedural lapse. AO neither granted hearing nor passed any order on the immunity application under section 270AA within the statutory period. The tribunal allowed the appeals for all 4 years in the favor of the assessee. Deleted the penalty under section 270A since there was no underreporting. Return and assessed incomes match. That is the more important. Return and assessed incomes are matched, then there will be no application of 270A subsection 2. Granted immunity under section 270AA as immunity conditions were met and AO failed in statutory duty to hear and reject the application time. Next, Vidjayane Durairaj-Vidjayane Velradjou vs. ITO 2024 625 ITA number 1457 of 2024. Relevant assessment year is assessment year 2017-18. Date of order 4th December 2024 and relevant section is section 54F. Let's understand facts and issue of the case. The assessee sold an immovable property during the relevant year and received part of the sale consideration in cash, subsequently deposited into both his and his wife's bank account. Okay, immovable property sold during the year, received a part sale consideration in cash, and subsequently deposited in both his and his wife's bank accounts. He purchased a new residential property not in his own name but in his wife's name using part of those proceeds. He claimed capital gains exemption under section 54F despite the new property being in his wife's name. The AO disallowed the exemption on the ground that the property was not purchased in the name of the assessee. Let's see what tribunal observed and held. Both the assessee and wife were assessed under a notice under section 148. Her return accepted by the AO. The AO's concern regarding the property purchase in the wife's name didn't impair the eligibility for section 54 exemption. Very important. The property purchase in the wife's name didn't impair the eligibility for section 54F exemption. The tribunal allowed the appeal and directed the AO to grant the full exemption under section 54F. The purchase of new residential property in the wife's name is permissible for section 54F exemption. And section 54F nowhere says that it is not allowed. The intention to invest the sale proceeds in specified asset matters and not the registered ownership of the new property. This is what very much important. What is important is the intention to invest the sale proceeds is important, but not the registered ownership of the new property. Next, KM Educational and Rural Development Trust versus ITO 2024 617 ITA number 1326 of 2024. The relevant assessment year is assessment year 2018-19. Date of order is 4th December 2024. Relevant sections are sections 12A, 12AA, and 139 subsection 4A. Let's understand facts and issue of the case. The trust, a charitable institution registered under section 12A and 12AA, filed its income tax return late. But within the extended time allowed under section 139 subsection 4A. Your trust filed belated return, but within the extended time allowed under section 139 subsection 4A. Despite timely filing in accordance with section 139 subsection 4A, the CPC-AO denied exemption under section 11 on the ground that the return was belated. Issue before the tribunal was whether the trust eligibility for exemption under section 11 is lost if the return is filed within the time allowed by section 139 subsection 4A, even though it is technically belated. Very much important. What tribunal observed and held is that the tribunal relied on relevant CBDT circulars, clarifying that trust registered under section 12A or 12AA, a return filed within the time limit set by section 139 subsection 4A is sufficiently valid, and such late filing doesn't disqualify the trust from claiming exemption under section 11. The AO's interpretation conflicted with statutory objective of section 139 subsection 4A and circular guidance. The assessing officer is not entitled to deny the exemption under section 11 if the return is filed within the extended corridor of section 139 subsection 4A. The appeal was allowed in favor of the assessee. The tribunal held that the trust is entitled to claim exemption under Section 11 as it filed its return within the extended time allowed by Section 139 subsection 4A, and such filing meets legal requirements. And now we are moving to cases reported to High Court. Let's see first case. Associated Chambers of Commerce and Industry of India versus DCIT 2025 473 ITR 696 Delhi High Court. Relevant assessment year is assessment year 1617. Date of order is 5th August 2024 and the relevant sections are section 11 subsection 2, section 147 and section 148A. Let's see what was the issue of the case. Whether the assessing officer will initiate reassessment proceedings under section 147 or 148, read with section 148A, and deny exemption under section 11 subsection 2 solely due to late digital submission of Form 10. That was the accumulation plan by the trust. Form 10 is for accumulation plan by the trust, especially when no portion of the accumulated income actually escaped assessment. Let's see what Delhi High Court observed and held. Section 11 subsection 2 clause A requires the trust to furnish a statement in Form 10 detailing accumulation purposes and mode. This is a procedural requirement. This is what? A procedural requirement, not a condition precedent for claiming exemption under section 11 subsection 2. The digital portal for Form 10 was introduced only in financial year 2015-16. Circular number 7 of 2018 acknowledged genuine difficulties faced by trust in timely digital uploading. The delay in electronic final without dispute on genuineness of the accumulation cannot transfer into taxable escapement. And the assessment order dated 1st December 2018 had already accepted the accumulation under section 11 subsection 2. Thus, assessing officers believed that income escape assessment lacked any factual basis and could not justify reassessment under section 147. Assessing officer didn't adhere to section 148A's requirement to provide a proper show cause notice and consider objections before issuing reassessment notice, rendering the process procedurally invalid. The High Court quashed both the reassessment notice and the order under section 147 and 148. It ruled that delay in digital submission of Form 10 doesn't warrant reopening where the accumulation under section 11 subsection 2 was accepted in the original assessment. The delay was due to procedural or electronic transition issues. No taxable income had escaped assessment. The AO failed to comply with mandatory section 148A hearing and objection process. Very, very important and very interesting question. Next, ESS Singapore branch versus DCIT 2025 473 ITR 541 Delhi High Court again, assessment year 2014-15. Date of order is 22nd August 2024. Relevant sections are section 199, 240 and 244. Let's see what was the issue of the case. Whether upon an appellate order in favor of the assessee, the assessing officer could restrict TDS credit to the amount originally claimed in the return, ignoring higher actual TDS deposited, proceed to compute the refund based only on claim TDS, despite higher credits reflected in Form 26A, determine interest and refund eligibility under section 199, 240 and 244 of the Income Tax Act 1961. Let's see what Delhi High Court observed and held. Section 199 unequivocally treats TDS deposited as tax paid. What TDS deposited as tax paid is retained. Once tax is deducted and booked in Form 26-AS, the assessee is entitled to credit even if not claimed in return. Very important. Please note down this point or note down this line. Once tax is deducted and booked in Form 26-AS, the assessee is entitled to credit even if not claimed in return by the assessee. Where refund arises from a non-revenue court's order, the refund must be granted automatically without requiring a separate claim. Where refund arises from a non-revenue court's order, the refund must be granted automatically. Interest becomes due from the beginning of the relevant assessment year until actual refund date. The AO's action in relying on a limited tedious claim in the return is misaligned with the legal mandate and contrary to the tribunal's directions and statutory provisions. The High Court quashed the AO's order. It directed the AO to acknowledge the entire TDS deposited as per Form 26-A under Section 199, grant refund automatically under Section 240 without requiring an application, pay interest from 1st April of assessment year 1450 until refund received under Section 244A. Very, very much important. Next, Principal CIT vs. Milia Tracon Private Limited 2025 473 ITR 155 Calcutta High Court. Block period was 1st April 1996 to 7th May 2002. Date of order is 3rd July 2024 and relevant sections are section 132 and section 158 BD. Let's understand what was the issue of the case. Whether proceedings under section 158 BD, that was block assessment of undisclosed income, can be block assessment of undisclosed income covered under section 158 BD, can be validly initiated against a non-search person on the basis of satisfaction note and seized materials without a satisfaction note recorded by the AO who conducted the search under section 132 and proper handover of seized books or documents to the AO of the non-search person. Let's see what Calcutta High Court observed and held. Section 158 BD requires that AO who conducted the search must record satisfaction that undisclosed income relates to another person and hand over the seized materials to the relevant AO of the non-searched entity. In this case, the satisfaction note was recorded by the AO of the non-search entity, not by the searching AO. In this case, the satisfaction note was recorded by the AO of the non-search entity, not by the searching AO. Further, no proper handover of documents occurred, both being essential steps for valid proceedings. The Tribunal and High Court held that initiating block assessments without satisfying these statutory prerequisites renders the proceedings completely without jurisdiction and hence void ab initio. It was void ab initio. The High Court dismissed the revenue's appeal, affirming the Tribunal's decision in the favor of the assessee. Next, Northern ARC Investment Manager Private Limited versus Deputy DIT 2025 472 ITR 154 Madras High Court. Date of order is 10th November 2023 and relevant section is section 143. Let's understand issue of the case. Whether in faceless assessments under section 143 subsection 1, the AO or CPC NFSC must intimate any corrections, additions or reductions made in the assessed income to the assessee and provide the assessee a real opportunity to respond before finalizing the information. These are the issues. Let's see what Madras High Court observed and held. Subsection 1 allows the department to process returns and make corrections However, any such changes require mandatory intimation to the assessee along with an opportunity to respond. However, any such change requires mandatory intimation to the assessee along with an opportunity to respond. Once the assessee is given notice of corrections, the response must be fully considered by the AO before issuing the final assessment order or intimation. Even in faceless assessments, procedural fairness, notably prior notice and meaningful consideration of rebuttals, is non-negotiable, means it should be required. The Madras High Court directed that the department must allow the assessee to file a reply to any corrections before issuing the final intimation order under section 143 subsection 1. If the reply is filed, the AO must consider it and recalibrate the intimation accordingly. The petition filed by Northern Investment Management was allowed, granting permission to file a rectification petition to address the double disallowance error and process the refund. Next, incredible unique build on Private Limited versus ITO 2024 470 ITR 106 Delhi High Court. Relevant assessment year is 2011-12 and date of order is 3rd November 2023. Relevant section is section 205. Let's understand what was the issue of the case. Whether when tax has been deducted at source by the payer but not deposited with the government, the assessee deductee can be compelled to pay the amount or be denied TDS credit, especially in the absence of Form 16A as per section 2045 of the Income Tax Act. What was the issue? Issue was whether tax has been deducted at source by the payer but not deposited with the government. The assessee deductee can be compelled to pay the amount or be denied TDS credit is what the issue under consideration, especially the absence of 16A. Okay. Let's see what Delhi High Court observed and held. Once it is established that tax has been deducted at source, Section 205 prohibits recovery from the deductee as self-assessment tax, even if the deductor failed to deposit the tax. It is irrelevant of whether Form 16A was issued or not. Very clear. High Court clarifies it that once the tax has been deducted at source, Section 205 prohibits recovery from the deductee as self-assessment tax. Even if the deductor failed to deposit the tax, it is irrelevant whether Form 16A was issued or not. While Form 16A is one form of evidence, it is not mandatory. While Form 16 is one of form of evidence, but it is not mandatory. Other reliable materials like the return disclosures, ledger statements, and complaints to the department can sufficiently demonstrate the existing of TDS. Form 16A is one of the form of evidence, but it is not mandatory. Other reliable materials like return disclosures, ledger statements, complaints to the department can sufficiently demonstrate the existence of TDS. The payment of TDS is the responsibility of whom is deductor, responsibilities of the deductor. The deductee cannot be penalized or held liable for non-deposit by the payer. And now we are moving to our conclusion part. Yes, whatever we have discussed till this cases reported to ITAT and reported to High Court, all the conclusions in one line form, in one liner form, I have here summarized. So please note down or take a screenshot for your ready reference so that it will be help you in your future litigation practice, or to revise those who are students and learning from this case laws. So what are the conclusions we can draw from the cases discussed? First, journal entries reflecting loan liability without cash transfer do not violate Section 269 SS. Penalty under Section 271D not sustainable. Then, unexplained cash payments for credit card bills without substantiating the source rightly attract addition under section 69A. Unexplained cash payment for credit card bills without substantiating the source rightly attract the addition under section 69A. Partner's capital contribution, when substantiated, cannot be taxed as unexplained income in the firm's hands under section 68 or 69A. Interest disallowance under section 36, subsection 1, clause 3 cannot stand when the assessee demonstrate sufficient interest-free funds. No underreporting exists when revised and assessed income match. No underreporting exists when revised and assessed income match. Immunity under section 270AA must be granted. Exemption under section 54A is allowable even if the new house is purchased in spouse name. Return filed under extended deadline of section 139 subsection 4A is valid for claiming exemption under section 11. Reassessment based solely on delayed e-filing of form 10 is invalid when accumulation is otherwise accepted. TDS credit must be granted for entire tax deposited regardless of amount claimed in return. Refund with interest is mandatory. Block assessment under section 158 BD is void without proper satisfaction by the search AO and document transfer. Faceless assessment under section 143 subsection 1 must consider assessee's response to proposed corrections. Section 205 prohibits recovery from assessee once TDS is deducted, even if not deposited by the deductor. This is what for today, part 4 of direct tax what law says. Thank you so much for patient hearing. Please note down my contact details. If you have any doubt, query, observation, suggestion, please do let me know. Thank you. Thank you so much. We'll meet you in this video series on every weekend basis. Happy learning. Thank you. Thank you so much.